So right now, the stock market is valuing a company at roughly $3 billion, and their core business is digging uranium out of the ground.
Right, a very traditional mining operation.
Yeah, but their profit margin is negative 82%. So why is Wall Street treating this cash-bleeding company like it's the absolute key to America's national security?
Well, it's this ultimate disconnect between current reality and future expectations. I mean, we're looking at a business operating in the gritty, capital-intensive world of mining, but it's being priced almost like a Silicon Valley tech unicorn.
It really is. And that's exactly what we are getting into today. We've got our hands on an equity research report dated August 7, 2026, covering Energy Fuels, Inc. The ticker symbol is UUU.
It's definitely a fascinating case study.
And as a listener, you've probably seen the endless barrage of headlines lately. We constantly hear about the AI energy boom, the sudden resurgence of nuclear power, and, well, this urgent geopolitical push to build U.S.-based supply chains.
Right, so we aren't completely dependent on China for critical minerals.
Yes.
And those headlines paint a picture of this inevitable transition. But they rarely explain the brutal mechanics of how a single company actually survives that decade-long process. I mean, building a domestic industrial empire from dirt to finished product is incredibly hard.
Okay, let's unpack this, because the gap between their $3 billion valuation and their actual cash flow is it's a mile wide.
Yeah, it's massive.
Right. So before we get lost in their grand visions for tomorrow, what exactly is their baseline today? Like, what are they actually doing right now to keep the lights on?
So the baseline right now is traditional uranium production. That's the engine currently generating cash. Management is guiding to produce approximately 1.6 million pounds of U3O8 by mid-year 2026.
Okay.
And they're pulling this from three main assets. You've got the White Mesa Mill, the Pinyon Plain Mine in Arizona, and the La Salle Complex in Utah.
I mean, that sounds incredibly solid, right? Especially given the current appetite for nuclear energy. But then you flip to their Q2 2026 numbers in this report, and they are genuinely brutal.
Brutal is the right word.
Yeah. Revenue came in at $25.1 million. Analysts were expecting nearly $32 million, so that's a 21% miss right out of the gate.
And the bottom line deterioration is even more severe. Earnings per share came in at a loss of 13 cents. The street was actually looking for a loss of just 6 cents.
Wow. So they more than doubled the expected loss.
Exactly. And it represents a 30% decline from where they were a year ago.
Which brings us back to that staggering net margin figure I mentioned up top, negative 82.7% over the trailing 12 months. But there's this paradox in the report that I really want you to explain.
Sure.
Their gross margin is actually positive, sitting at nearly 35%. That means they were selling the uranium for significantly more than the direct cost of getting it out of the dirt, right?
Right, and that is a crucial distinction. The core mining operation actually works. If they were just a simple uranium miner, they would have a functional, albeit cyclical business.
Right, a normal mining business.
Yeah, but they aren't just mining. That negative 82% net margin is the result of immense corporate overhead and exploratory capital expenditures required for their future plans.
Oh, okay.
Those forward-looking expenses are completely obliterating the gross profit they made from the uranium.
So it's kind of like having a lemonade stand where the lemons cost a nickel and you sell the juice for a dime. Like, great gross margin.
Right.
But you've decided to take out $1 billion loan to build a high-tech synthetic flavor lab in the backyard, well, before you've even sold your second cup of lemonade.
That analogy hits the nail on the head. They are financing an incredibly expensive pivot. And yet, despite the intense cash burn, the market capitalization is hovering around $3.08 billion.
Which means we're looking at a price-to-sales ratio of over 36. For a mining company, I mean, 36 times sales is a multiple you usually see for a hyper-growth software company with 90% margins.
Not a company pulling radioactive rock out of the desert.
Exactly. Clearly, Wall Street does not care about the current uranium output. They are valuing this company entirely on a pivot that hasn't actually happened yet. So let's look at this multi-billion-dollar vision. What is it?
The vision is a vertically integrated U.S. mine-to-magnet platform, and it's focused heavily on rare earth elements.
Mine to magnet, okay.
Yeah, so instead of just pulling material out of the ground, Energy Fuels wants to mine it, process it, separate it, and eventually produce the permanent magnets themselves.
And those are the magnets essential for everything from electric vehicle motors to wind turbines and even military defense systems, right?
Exactly. And the report highlights a major milestone they actually hit in March of 2026. They achieved pilot-scale production of terbium oxide at their White Mesa mill.
Which the report notes is the first U.S. primary production of this specific material. But, break that down for us. Why terbium, and why is pilot scale such a big deal?
Well, terbium is incredibly valuable because it's the magic ingredient that allows magnets to operate at very high temperatures without losing their magnetic properties.
Oh, so like if you have an EV motor running hot on the highway, you need terbium in those magnets.
Spot on. But extracting it is notoriously difficult. Separating rare earth elements isn't just about crushing rocks. Chemically, they behave almost identically.
Because they sit right next to each other on the periodic table.
Yes. To separate them, you have to use highly complex, hazardous solvent extraction processes. We're talking sequential acid baths, immense precision, and heavy environmental waste management.
Wow.
So proving they can do it at a pilot scale proves the chemistry actually works.
Yeah, but proving the chemistry works in a controlled batch is light years away from doing it at a commercial scale, right? Because that requires massive infrastructure.
Absolutely. And to build that scale, they went on a bit of a shopping spree. In June 2026, they announced a definitive agreement to acquire a European company called VAC for $1.9 billion.
And this acquisition is supposed to give them the actual magnet manufacturing capability to complete that mine-to-magnet supply chain.
That's the plan.
But wait, this is where I have to call out a glaring red flag in this research report. They are paying for this $1.9 billion acquisition entirely in stock, like all equity.
That is correct. The deal structure is 100% equity.
But just look at the stock chart. The stock has been in a sustained, brutal decline since January of 2026. It's down nearly 54% from its 52-week high of around $28.
Sitting near $13 today.
Right. So how do you defend them issuing shares when their primary currency, their stock, has lost half its value? That is financial suicide for existing shareholders.
It's definitely painful.
I mean, they are giving away twice as much of the company to fund this deal than they would have just 6 months ago. Why aren't investors rioting?
Well, this raises an important question about the alternatives. You have to look at the macroeconomic reality they are operating in. Yes, heavy dilution at depressed prices is agonizing for current shareholders.
Extremely agonizing.
But look at their balance sheet. They do not have the operating cash flow to service a $1.9 billion debt load at today's interest rates.
Because of that negative 82% net margin?
Exactly. If they took on that much debt, they would enter a death spiral the moment there was even a tiny hiccup in uranium prices. Dilution is incredibly painful, yes, but a debt default is fatal.
So they're just using the only lever they actually have to secure the asset.
Precisely.
I hear that, but it doesn't end with the acquisition cost. Buying the magnet manufacturer doesn't miraculously build the processing facility back in Utah.
No, it does not.
The report explicitly outlines that Phase 2 of their rare earth separation circuit at White Mesa requires an estimated $410 million in initial capital expenditures. And they haven't even made a final investment decision on that yet.
And keep in mind, Phase 1 modifications aren't even scheduled to be operational until late 2027 to early 2028.
So you have a 2 to 3 year window where they are just bleeding cash on development.
With zero incremental rare earth revenue coming in to offset it.
Wow, and they aren't operating in a vacuum while they spend this money either.
Far from it. Until Phase 1 and Phase 2 are fully commissioned and producing commercial quantities, Energy Fuel's competitive moat against established giants is purely aspirational.
Right, because they are going up against MP Materials in the U.S., Lynas in Australia, and, of course, the Chinese state-backed processors.
Exactly. China spent 3 decades cornering this market, heavily subsidizing the incredibly toxic refining process to drive competitors out of business.
So they have entrenched cost advantages and just massive scale.
Yes, and breaking into that monopoly is going to require absolutely flawless execution.
Okay, so to recap the current situation, we have a company with terrible net margins, a stock price cut in half, a pending $1.9 billion highly dilutive acquisition, and another $410 million in facility building costs before we even get to 2028.
It's a lot to take in.
Yeah. Any traditional value investor would run screaming from this balance sheet. For Energy Fuels to survive this transition, they need the broader market to stay absolutely obsessed with their overarching geopolitical thesis.
Which brings us to the macroeconomic tailwinds that are essentially keeping this entire endeavor afloat. The sentiment tug-of-war here is really fascinating.
Let's get into that.
First, you have the political landscape. The Trump administration has made domestic critical mineral production a cornerstone policy, aiming to force supply chains out of China and back onto American soil.
And the sources here are fiercely divided on how viable that policy actually is. Because on one hand, the equity report treats this political momentum as a major catalyst for energy fuels.
Right.
But it also explicitly points to a deeply bearish article from July that bluntly labels this entire domestic policy a $6.5 trillion trap.
Which is a staggering number.
It really is. The argument there is that U.S. self-sufficiency isn't just expensive, it might actually be physically impossible. The sheer volume of earth that needs to be moved, combined with America's notoriously slow environmental permitting process, means domestic supply simply cannot meet the projected demand, no matter how much government money is thrown at it.
Now, whether you believe the policy is a masterstroke or a multi-trillion-dollar trap, you have to recognize how the market is trading on it. We are just looking at the facts of the market reaction.
Right.
Exactly. If investors start believing domestic self-sufficiency is a pipe dream, the foundational narrative propping up energy fuels valuation collapses.
But if the market believes the government will enforce domestic sourcing regardless of the economic inefficiency, then energy fuels is perfectly positioned.
Precisely. It is a massive external variable completely out of the company's control.
Then you have the secondary macro force, which is the AI data center boom and its insatiable demand for electricity. That seems to be acting as a massive safety net for the traditional uranium side of their business.
Oh, AI data centers are changing the energy calculus entirely. They require enormous, uninterrupted 24/7 baseload power.
Which you can't really get from just renewables, right?
No, tech companies are realizing that you cannot run a gigawatt data center purely on wind and solar without unimaginably large battery storage facilities.
And ironically, those batteries require the very critical minerals we've been talking about.
Exactly. So they are increasingly pivoting back to nuclear energy for reliable baseload power. That fundamental shift in demand guarantees a long-term floor for uranium prices.
Which is Energy Fuel's primary lifeblood while they try to build out the rare earth business.
Exactly right.
Well, speaking of lifeblood, let's talk about insider confidence. The report pulls data from SqueezeWatch tracking insider transactions. And over the last 90 days, there were 4 buy transactions and 0 sells.
Okay.
The total volume was 95,730 shares, amounting to roughly $1 million. Now, the bullish spin is that management is buying the dip, putting their own money on the line.
Yeah, that kind of cluster buying is usually a strong signal. It shows the executives believe the 54% drop in the stock price is an overreaction.
But consider the scale here. I mean, $1 million in insider buying sounds impressive on a retail level, but we are talking about a company with a $3 billion market cap.
It is a relatively small percentage.
It's a rounding error. It barely covers the catering budget for their $1.9 billion acquisition meetings. So, is this true conviction from the C-suite? Or is this just a calculated PR gesture, like a cheap way to print a positive headline and calm nervous retail investors while the stock just continues to slide?
What's fascinating here is how that exact tension defines the entire stock right now. You look at the news flow, and it perfectly mirrors the split sentiment.
How so?
Well, on one side, you have glowing articles about their de-risked path to a rare earth giant and celebrations of their pilot terbium production. The mine-to-magnet thesis is undeniably compelling for anyone who cares about national security.
But then on the other side, you have the freshest, most concrete data point available to investors, which is the Q2 earnings report.
Right, a double-line miss on both revenue and earnings, accompanied by a staggering net margin deficit.
So the current financial reality is undeniably hostile. The market is trapped between investing in a vital, brilliant geopolitical strategy and buying into a deeply unprofitable, highly dilutive corporate reality.
That's exactly it.
So, with a world-class narrative, terrible margins, and an incredibly expensive to-do list sitting on the CEO's desk, what actually happens next? Like, how do we map out the path forward for someone trying to evaluate this company today?
The research report lays it out quite starkly. The path to recovery is exceptionally narrow. It requires 12 to 24 months of near-perfect execution on multiple fronts simultaneously.
Perfect execution from a company currently burning cash and missing estimates. I mean, that is a tall order.
It is the ultimate tightrope walk. First, they had to close the $1.9 billion VAC deal successfully.
Okay.
But beyond just closing it, they have to prove to the market that integrating a European magnet manufacturer won't just add immense operational complexity, but will actually contribute to top-line revenue in the near term.
And second,
Second, they have to stabilize their traditional uranium business. They need predictable, expanding cash flow from the White Mesa and Pinyon Plain sites just to stop the bleeding on the balance sheet.
And we actually have some very specific dates and catalysts to watch here. Early November 2026 brings their Q3 earnings report. That is going to be a critical pivot point, isn't it?
Absolutely. If they miss estimates again, or if they post another severe deterioration in earnings per share, the market's patience for this long-term transition might simply evaporate.
Right. And they also need to clear all the shareholder votes and regulatory hurdles to officially close the VIC acquisition. But according to the report, the single most vital catalyst on the horizon is the potential signing of commercial offtake agreements.
Yes, offtake agreements are the absolute lifeblood of these massive infrastructure projects.
Can you explain that for the listeners who might not be familiar?
Sure. For context, an offtake agreement is a legally binding contract where a major buyer, say a massive automaker or a defense contractor, agrees in advance to purchase a set amount of your future production of materials. Things like neodymium, praseodymium, terbium, or dysprosium.
Okay, so why does that matter so much to the stock price today if the materials won't actually be produced until 2028?
Because it makes the project bankable. If Energy Fuels goes to a bank or the public markets to raise that $410 million needed for Phase 2, the lenders are going to demand proof that someone actually wants to buy the end product.
Ah, that makes sense.
An offtake agreement guarantees future revenue, which massively de-risks the capital expenditure. It proves to Wall Street that the entire platform strategy is commercially viable.
But until a major player actually signs on the dotted line, the entire rare earth facility is entirely speculative.
Correct.
And all of that uncertainty culminates in the report's final assessment. They give the stock a rating of 4 out of 10, with an official stance of neutral, cautious. So what does this all mean for you, the listener, trying to make sense of this sector?
It means this is not a play for the faint of heart, and it is certainly not a short-term trade based on current fundamentals. Investors here are strictly betting on optionality.
Like buying a lottery ticket.
Exactly, on the chance that Energy Fuels becomes the indispensable cornerstone of the entire U.S. critical minerals supply chain by the end of the decade.
But the cost of holding that lottery ticket could be really steep. I mean, if the company struggles to execute, or if uranium prices dip, they will be forced to go back to the public markets to raise that $410 million.
And if they have to issue more equity at unfavorable terms, current shareholders are going to face another brutal wave of dilution.
Yeah.
If we connect this to the broader geopolitical landscape, Energy Fuels is acting as a fascinating, real-time stress test for the American economy. It is showing us exactly how brutally difficult it actually is to rebuild heavy industry from scratch.
Because for 3 decades, the U.S. was perfectly happy to outsource the heavy, messy, hazardous, and expensive refining work to China in exchange for cheap consumer electronics.
Right.
We loved the cheap iPhones, we just didn't want to look at the toxic lakes required to build them.
Precisely. Now suddenly we want that capability back on our own soil for national security reasons. But bringing it back means enduring years of negative margins, billions in capital expenditures, and an incredible amount of execution risk.
So Energy Fuels is doing exactly what the politicians are asking for, and their reward is a stock price that has been cut in half because the public markets hate the near-term financials.
That's the reality.
Which leaves us with a really provocative question to mull over. We all want the finished product, right? We all want a future where America is totally self-sufficient, powering an AI revolution with clean nuclear energy and building electric vehicles entirely from domestic materials.
Sure.
But right now, we're looking at the messy reality of how you get there. If public markets, driven by quarterly earnings and strict margin requirements, are hesitant to fund the deeply unprofitable 10-year transitions required by companies like Energy Fuels, who ultimately fits the bill?
That is the multi-trillion-dollar question hovering over this entire sector. Because if retail and institutional investors get tired of the dilution and they refuse to finance the gap between the pilot phase and commercial scale, the transition stalls.
Will the government eventually have to step in?
Exactly. Will the state have to bypass the free market and act as the ultimate venture capitalist, directly funding these critical mineral companies just to ensure national security?
It is definitely something to think about the next time you see a flashy headline about the AI energy boom or domestic supply chains. The geopolitical transition isn't just a political talking point. It is a brutal, bleeding balance sheet, and sooner or later, someone has to pay for it. Thank you for joining us on this deep dive. Keep questioning the numbers behind the narratives, and we'll catch you next time.